Good evening, ladies and gentlemen, and a very warm welcome to the first in a three-part series of maritime sector-related webinars hosted by the Chartered Institute of Logistics and Transport in Singapore. Now, kicking off the proceedings for this evening is myself, Siddharth Adia. I'm a director with CILT Singapore and will be the moderator for our discussion. We are expecting a full house this evening, and I see a lot of you already dialed in. So first off, I'd like to thank you for your time and interest in joining our discussion today. And for those that did, for sending us your questions prior to this event. The speakers have tried to address quite a few of the questions in their respective presentations. That said, do keep the questions coming in, and we will endeavor to take on a few more once the three speakers have delivered their respective speeches. For those that we're unable to cover today or address at the end of the session, we'll ensure we post a response from a panel of experts post the event. Now, the topic of this evening's discussion is container shipping, a sector that has generated much interest globally and seen perhaps one of the most pronounced performance changes by any industry sector in recent years. From being widely touted as an industry that did not even make its long-term cost of capital, the container shipping sector saw its profits soar through much of the pandemic era and much of last year, driven by soaring demand for containers and space on ships that drove freight rates to levels not seen before. And yet, here we are a year later. Recent industry reports now suggest that global trade is expected to grow somewhere between 0 and 2% for the year, with some lines now even predicting a contraction in container shipping volumes of between 1 and 4% for the remainder of the year. Most carriers have reported steep declines in revenue and profitability metrics year over year for their Q2 performance. And all of this with the backdrop of slowing container demand, with China recently reporting its biggest drop in exports in over 3 years for July. So what does this mean for the container shipping outlook as we look to the rest of 2023, and where is the industry headed? It gives me immense pleasure to introduce our panel of experts for this evening who will talk us through and help us make sense of the dramatic swings within the industry in recent months. The three gentlemen on our panel bring with them in-depth industry experience and a solid understanding of the container trades globally. So without further delay, I'd like to call on Mr. Goh Teck Jin to start us off with his views on the industry. Teck Jin is Senior Vice President of Global Terminal Management at Ocean Network Express and has a career spanning 27 years in the shipping and logistics sector. So Teck Jin, over to you, please.
Thank you very much, Siddharth. Just to do a sound check, can everybody hear me?
Yeah, you're good.
That's very good. Thank you. So good evening again, ladies and gentlemen. Welcome once again to the latest edition of the Chartered Institute of Logistics and Transport webinar. This evening, I will be speaking on the outlook of the liner industry. Discussion on this topic would generally include a reference to the global economy. Given that the world has changed quite significantly over the last 3 years, such discussions would therefore inevitably include a reference to the COVID-19 pandemic. It is no different when it comes to a discussion on the outlook of the liner industry, and therefore let me bring you back to the height of the pandemic in July 2021. So this slide shows the public transport closures globally at the height of the pandemic. As you can see, almost all countries, those shaded in red and orange, implemented border controls. As I'm sure you would recall, air travel was pretty much shut down. We became very good at Zoom meetings like this, and working from home became the norm. All these restrictions and changes did something unprecedented to the global economy. Cooped up at home with nowhere to go, we spent our money on goods instead of services. As you can see from the chart, historically, spending on services generally outpaced spending on goods. But this flipped as we moved into the height of the pandemic. While spending on services fell off the cliff to levels last seen in 2006, spending on goods, after a brief fall, skyrocketed to unprecedented levels, increasing by 20% compared to pre-pandemic levels. If you remember, we bought new computers. laptops, printers, and cell phones. This led to a shortage of silicon chips due to the overwhelming demand. We also bought office furniture so that we can work from home in comfort. Since we could not spend our money on holidays or eating out or going to the cinema or shopping, we bought home improvement items, gym equipment, home entertainment systems, and the like to deal with the challenge of living in isolation. All this was really good news for the shipping industry, actually. With a greater demand for goods and pandemic-induced reduction in capacity due to COVID-19 measures at ports, freight rates went through the roof, as you can see on the right side of this chart. So I believe I've therefore addressed a question posed, which was why freight rates had risen recently. By recently, I believe the person meant in 2021 and 2022, because as you shall see shortly, things have changed somewhat since then. For now, though, as you can see in this chart, the average operating margins of carriers had hovered around zero since 2009. But beginning in the third quarter of 2020, operating margins started to climb steeply to reach a dizzying high of more than 55% by the end of 2021. This chart shows the net income of the liner industry as a whole. Historically, the industry struggled to break even, as you can see. But by the second quarter of 2022, the industry was collectively making a whopping $220 billion a year. The exuberance cascaded along the chain. Ship owners wanted a piece of the action. A shortage of ship capacity drove up charter rates, as well as the cost of new builds. The fear of missing out sets in, and carriers rushed to fix and order ships at relatively high prices. The same situation occurred with new containers. Prices doubled. Those in the industry will remember the price of a 20-foot going from $2,000 to $4,000. Again, due to boxes being stuck on ships, ports, warehouses, thereby creating a shortage, carriers made huge orders at these high prices or committed to long-term 10-year leases. Unfortunately, though, the music stopped. Freight rates peaked around the middle of last year and have since gone back to pre-pandemic levels. For example, freight rates on the Trans-Pacific trade was between USD 9,000 and 10,000 at its peak. This has now gone back to lower than even 1,500 some weeks ago. Against this backdrop of decreasing freight rates, carriers have started to take delivery of a large number of new builds ordered during the pandemic. Almost 2.3 million TEUs of capacity will be added this year, and close to 2.8 million TEUs next year. A London shipbroker commented in 1894 that the amount of tonnage on order guarantees a long continuance of low freight rates. Now that was in 1894. Fast forward 130 years and it seems nothing has changed. Alpha Liner observed in October last year that a huge number of new large container ships are going to hit the water at a time of stagnating demand. I think they couldn't have been more right. So how do these ship deliveries impact capacity on the major trade routes? This slide here shows just how those additional capacity impact the Trans-Pacific routes. Capacity on the TP trade is projected to grow by up to 20% even as peak season approaches. On the Asia-Europe trade, capacity is expected to increase even more by more than 40% year on year. As we can understand, that tends to happen when new builds are delivered. Given the size of those monsters, they tend to be delivered on the Asia-Europe trade first, thereby increasing the capacity hugely. So now we circle back to where we started to look at the post-pandemic world. This was the status of public transport closures in mid-2021. Fast forward to December 2022, and we see how the world has changed. As you can see, almost all countries have abolished border controls. As a sign of the times, air travel has resumed with a vengeance. Singapore Airlines made record profits of $2.7 billion in 2022, the highest in its 76-year history. Pre-pandemic norms are returning. Spending on services has been increasing at the expense of spending on goods. So I think I've answered one of the questions posed by a delegate who asked why freight rates have gone lower than pre-pandemic levels. So where is the industry headed? To answer the question, let's sum up all that's been discussed so far. Carriers will be facing high fixed costs by way of new builds and containers. New tonnage delivery over the next 2 years will significantly add to capacity. Demand for goods has fallen back to pre-pandemic levels. These last two developments have led to a supply-demand imbalance, which then leads to competition, which then leads to falling rates and more competition. So where does all that leave us? A clue to the question may be revealed in this slide, which shows the latest financial performance of the liner industry as of the first quarter of this year. Earning before tax has fallen off the cliff from the high in 2021 and 2022. The answer to the question may therefore be derived by looking at that trajectory there. But forecasting anything is usually difficult, unless you have bought that special crystal ball from Amazon. So perhaps we should look at what has happened already in the industry as a sign of the times to come. This could well be the first casualty of more that is to come for the rest of this year. Maybe. Thank you for your attention. Siddharth, you're on mute.
Can you hear me now?
Yeah. Yes, you can.
Thank you, Dangchen, for sharing your views and some solid data points indeed for all of us to think about. Now, next, I'd like to invite Mr. Raul Carvalho, Commercial Director, South Asia, Middle East and Africa at C.H. Robinson, to share his views with us. Now, we've heard from Tagjen, the container shipping representative on our call just now, and now Raul perhaps bringing a slightly different perspective as a global freight forwarder. So looking forward to your views, Raul, and what the world looks like from your perspective. Over to you, Raul.
Thanks for that. So, yes, so I'll cover three topics. One is product diversification within the industry, the role of shipping alliances and its relevance, and a general outlook in terms of a forecast for the second half of 2023 and the financial year for 2024. So moving into the next slide, I just want to touch upon how the container, so that if you could just move to the next slide, please. Yeah, I would just like to talk about how the containerized industry has evolved over the last couple of years. So if we take a pause and think over the last 25 years, how has the shipping industry really revolutionized? 25 years ago, if we really looked at it, we had smaller ships, which were in the range of 10,000 to 15,000 odd vessels. The largest vessel that came out in 2004 was a vessel called Emma Maersk, which was 15,000, and we all thought that 15,000 TEU vessel would revolutionize and be the largest that would be in capacity. 2023, we have a vessel size, which is MSC Irina, which is 24,346. If we really look back in terms of the containerized industry, earlier shipping lines would like to be looked at or perceived as a carrier that moved cargo from A to B with a good level of customer service, operations, and some level of track and trace. 2023, everything is digitalized. Carriers have embraced e-commerce platforms to improve their competitiveness, have a number of niche products that have been created. The pandemic has brought about the necessity to have niche products. So you've had a lot of products, be it first mile, be it last mile, be it dedicated services, be it booking amendment fees, be it SPGs that were specific guarantee fees where you wanted to ensure that your cargo got loaded. And the carriers have really embraced technology and also played a lot of focus in terms of blockchain or very specialized service to ensure that there's a connectivity right from the start to the end. You would have seen over the last couple of years that cybersecurity has also been a major issue with shipping lines. And carriers have tried to address that. They've got a lot of revenue at this point of time. And cybersecurity is something that they've been playing a large focus on. But as we've moved towards the end of the pandemic, I think a number of the carriers, if you look at the top 5 carriers, they have shifted their view from a profitability, rather from a market share perspective to that of a profitability perspective. Carriers want to be viewed as integrated service providers, offering solutions right from the first mile to the end mile, rather than just being part of an alliance or being a standalone service. A lot of you would have read somewhere last year, and in the beginning of this year, the 2M had a rejig, that is the MSC and the Maersk service. I'll come to that when I cover alliances a little bit later, but that will also set the pace of how the industry will change. Shipping lines have also collaborated with a lot of stakeholders across, be it ports, be it first mile transporters, be it last mile warehouses, etc., in order to have an integrated solution that you can approach them with. Digitalization, a lot of artificial intelligence, carriers have aligned their services into data-driven revenue streams and shifts to ensure that you're addressing the requirements of the trade. I'll move to the next slide, because in the next slide, this is something that shipping lines are concentrating on, because as we move into an ESG environment, carriers are also talking a lot about decarbonization. There are shipping lines which are focusing a lot in terms of sustainable fuels. Today, you have methane vessels, you have LNG vessels, you have battery-operated vessels. COSCO a few weeks ago launched 2 800 TEU vessels, which are completely battery-operated vessels, all in order to ensure that they have sustainable supply chain solutions, and also from a shipping perspective, they reduce their carbon footprint in that of the industry. Autonomous ships are also, they have embraced technology. A lot of ships that are coming in, and if a lot of you have ever tried to see in terms of virtual reality devices, and you can see the size of the ships, they will actually explain to you as to how these actually operate. So that if you could move into the next slide, please. Shipping alliances. So we have 3 alliances, as you all know at this point of time. That's the 2M, the Ocean Alliance, as well as the Alliance. The next slide would give you a brief in terms of the split, as well as the carriers that are part of it as per the 2022 Alliance. The 2M is definitely the largest alliance, followed by that of the Ocean Alliance, as well as the Alliance. As I mentioned, in 2025, next year, the 2M had decided, MSC and Maersk had decided to separate and move in different directions. The Ocean Alliance has its largest, I would say, market share, both in terms of the Asia, North America, as well as the Europe trade. Now, a lot of this I personally perceive, and this is my opinion, I don't have a crystal ball, but I personally perceive as we move into 27 and 2030, it will be the survival of the fittest. A lot of them will also change. You could have some standalone services. If you reflect back a couple of years ago, there was this concept of daily Maersk, and where every day you had a service which was sailing into Europe, and it was largely hailed as a very good service. I personally view that, with carriers shifting their strategies in terms of prioritizations of logistics needs, that could happen where you would see a lot of standalone services that come in. So that if you could move to the next slide, please. As I mentioned, MSC and Maersk will discontinue. The Ocean Alliance will end in 2027, so you could have a rejig down there. The Alliance ends in 2030. niche services could take center stage. Everybody knows the long haul services in this industry play a vital role because that's where you make money. So carriers could collaborate over there for certain services, but for certain services, they could launch their own niche services. Decarbonization would play a very, very important role now, where in a situation where you have carriers and some fleets of the shipping lines have older fleets, you could see a lot of disruptions because you can't have a network that is moving and some vessels which are non-compliant. The new order books are relying on sustainable fuels, as I earlier mentioned, LNG, methanol, battery-operated ships. A lot of you would have seen SM Lines, which is in the news over the last couple of weeks, with a potential buy of HMM. If that happens, things could change. There's a lot of talk about the Taiwanese as well as the Korean carriers. But if that changes, then all these alliances will change, as well as the capacity that will be moving in from east to west or from west to that of east. So that if we can go to the next slide, please. If we look at the outlook, right, I think as TechGen really said, and I want to cover that too, and I think he shared a very important perspective. And if I really look at it, today, the difference in terms of capacity between that of MSC as well as Maersk is 1 million odd TEUs. MSC has approximately 5.3 or 5.4 million TEUs. Maersk has around 4.2. The difference between them in terms of capacity is 1 million TEUs. In 2024 and 2023 and 2024, you have close to around 5 million TEUs which is coming in, which is the equivalent of one brand new shipping line in terms of pure capacity. That's 5 million. You have 2.3 million, which is coming to 2023, and in 2024, you have 2.8 million. So while shipping lines will continue to reposition themselves, they have plenty of cash flows with them. You could see an era of possible mergers and acquisitions. They have massive cash reserves. They will want to get into various activities that would be of strategic importance to that of them. You have excess capacities. I do not see a scenario where the market will stabilize. There's plenty of capacity. The only way the carriers can really push for the rates to go up is by controlling capacities. Today, the inactive fleet is at an all-time high, right? There's rate volatility across the market, and the market is only falling. You actually see that the rates rising at particular periods of time, but that is actually an artificial increase because space is being tightly controlled in terms of moving the cargoes, a lot of blank sailings, etc., which is moving in. Now, with all the new capacity which is actually coming in, right? You have big, large vessels which are 25,000 TEUs almost. Where will the smaller ships go? They will move into secondary lanes. And in the secondary lanes, you do not have enough of demand, right? If you had enough demand, you would have 25,000 TEUs. So those markets are also it's going to be a cascading effect where those markets also see an excess demand, excess supply, which will ensure that the freight levels also have an impact over there. Impact of IMO and its regulations. I mean, these are all disruptors in the market because as we evolve, when you want the rates to go up, right, you look at disruptors where there's capacity constraints, where demand and supply, there is a challenge over there, and that's how the rate goes up. But when you have disruptions on a consistent basis where capacity is actually in excess, right, the only thing that's going to change there is there's going to be a consistent pressure in terms of that of the rates. So IMO, as the IMO regulations come into play, and if there's no shift in that of dates in terms of implementation, you could see a number of non-compliant vessels moving out, tighter sulfur emission norms across, whether it's Europe or whether it's US, where they are very focused in terms of protecting their life below the sea, and that will also impact capacity. So if you could just go to the next slide, please. Right. There's also a number of macroeconomic factors, geopolitical. Everybody knows the challenges with that of Russia at the moment, China, US, etc. And that is also some factors which will determine how the trade really moves and how the market will move. There's no doubt at this point of time, a lot of cargo is moving from China into the US, as well as some cargo has moved from Southeast Asia into the US. There's been some change in terms of the market, but the labor dynamics will continue to shift depending upon geopolitics within the regions. We've not seen an uptick in terms of demand overall. TechGen did present that overall, But US consumer spending as well as retail sales will have an impact on the shipping industry. If that goes up, if there's a lot of consumer spending and there's an increase in demand, which I do not foresee it to reach the pre-pandemic levels, the demand is going to ensure that it's just at a level where the rates remain stagnant over a period of time. At the start of this year, contractual agreements, a lot of the big players in the market, sought to buy premium freights. But all that has been renegotiated because there's just not enough demand in that of the US. The warehouses, though they're dipped in demands of stock, we still see a few challenges overall in terms of it. The ILWU and the PMA's negotiations are still on. That has been a never-ending story. So all in all, when I really look at it in terms of an outlook for 2023 as well as 2024, I personally view that it's going to be a subdued market. So that's it from me from my end. Yeah. Over to you, Siddharth and Patrick. Siddharth, you're on mute.
Sorry about that. I guess need to not so used to Zoom anymore. But thank you, Rahul. Again, interesting perspectives, and I think interesting perspectives from first two of our industry experts. Now, let's listen to our next expert, who has perhaps a slightly different take on things. Projects and special cargo has generally been a much understated segment of the industry. Yet with relatively high margins and prospect of offering improved slot utilization, it is an area that the carriers are increasingly looking at and investing in. It is a very specialized segment involving significant technical expertise. So let's hear more from Mr. Patrick Wong, an industry veteran, having worked across geographies and in several core functions with some of the largest container lines globally. Patrick, over to you.
Thank you, Sid. Just do a quick sound check. Can you hear me?
Yeah, you're good.
Thank you. Good evening, ladies and gentlemen. It is actually very interesting for me when I got this invitation to speak about special cargoes, because typically in any talk on container liners, special cargo is so niche that we hardly show up on the radar screen. But I guess COVID has kind of changed many things, and the fortunes of special cargo on container liners has definitely taken on a very much higher profile since then. And as we go into a situation with anticipated supply and demand imbalance in terms of container liner capacity, more and more container liners will likely be investing more in this area, both in terms of the equipment required, as well as in their organizations, meaning teams of knowledge, as well as the in-house processes, right? So let me take you all through some of the points that I'll be going through this evening. Yeah. Thank you, Sid. So just a quick overview of some of the insights that I'm going to share. I'll give a brief introduction on special cargoes, the role of special cargoes to container liners, some operating challenges for container liners in managing special cargoes. And the million-dollar question for container liners is, can special cargoes be a sustainable product? And I suppose for this audience, how can 3PLs work with container liners, right, for special cargoes? And last but not least, a couple of quick outlook points for special cargoes going forward. Next, please. Okay, so for container liners, special cargoes basically refer to cargo, they are shipped using special equipment. These are mainly the open top containers or flat rack containers, right? As you can see from the slide, these are some of the prime examples of stuff of the commodities that are carried this way. So a big part of the special cargoes that is typically not so traditionally associated with container liners are the break bulk cargo, right? Basically, these cargoes are handled without lifting a container. Right? The containers, the flat racks used basically are just to support, to provide the lashing points. Okay, so any mention of special cargo in a container liner context typically refers to OOG cargoes, which is short for out of gauge. Okay, basically cargo dimensions that exceed that of a standard ISO container. Next, please. So the special cargoes traditionally is a very, very small part of container liner shipping, mainly because there is much less expertise to deal with the operating conditions, and typically that is limited to the operations side of the company. So there's a lot less of selling such services, typically. So until recently, that has been the case. So how recent is recent? I think as our first speaker, Mr. Goh Teck Jin, referred to the change in the market condition probably pushed special cargo into a very high prominent position as of the middle of last year, when freight rates for container freight rates started falling off. So container carriers have, now resorted to seeking out special cargoes to help improve fuel utilization. Okay. So this is primarily what a lot of container liners are now doing. Okay. On the other hand, special cargoes also help utilize the vessel better by making better use of the tonnage, meaning the amount of weight that can be accommodated on the ship. So in markets, especially like perhaps for those of you who are familiar, the Indian subcon, the average container weight tends to be heavier. So special cargoes typically would reduce the average weight per container. A big part of what the container liners are looking at now is to improve yield. So this is a big driver because costs have gone up very significantly for all container liners in terms of operating costs as well as the fixed costs. And as pointed out by Rao, increasingly container liners are focusing on building a strategy to offer a more comprehensive product range to their customers. This is essentially a key response, to ensuring that they are more focused. The customers can remember a particular brand better, and this is particularly important to the mega carriers who are, making themselves unique, such as MSC and Maersk, right? And increasingly for CMA CGM. Next, please. Now, there are many challenges with managing special cargoes on board. So as the diagram shows, these are break bulk cargoes, and they take up quite a bit of space. And you can see that that there's quite a bit of additional work that is not traditionally associated with the container liners, in the sense of the lashing involved. You can see a lot of the lashing belts there, right? So the primary challenge for many container liners is pricing for the so-called lost slots that you can see from the picture there. So you can see that there are something like 12 containers here, and it's 3 high. So that's quite a bit of lost slots used in carrying such cargoes. And associated with this is, of course, the operational part, where there are there's approvals, and that translate into normal liner processes, like something as simple as booking, and the issues that are linked to lead time and equipment availability, and so on and so forth. So for those of you who have worked in this area, you will know what I'm talking about. Now, there's a lot of specialized resource required in working with special cargoes, especially break bulk handling. So typically, the setup will involve operations person in charge to work through the loading plan with the stevedores, and coordination with the container terminal, and so on and so forth, right? And there will also be a complex network of sales to deal with the shippers and understanding their requirements, okay, and the passing of key information, and so on and so forth. Next, please. Now, how will third-party logistics players work with container liners for special cargoes? I think essentially it will be a key part of this will be the interface point, meaning who are you working with? Often or increasingly, we will see container liners now building teams of special cargo teams whose sales have more knowledge of such cargoes, and are able to work with operations directly to help with managing all the processes and issues that come up. Right. I think that's the main thing that 3PLs will look out for. And also, as pointed out by Rao, in the potential realignment of alliances, the vessel operator will be a key consideration in selecting the ocean carrier, simply because operations control for handling of specialized equipment and cargoes are really very challenging. So that will require some key focus. Okay. Next. Okay, in our last part, I will share some outlook for special cargoes. I think, and it is my personal opinion, that special cargo focus will definitely increase going forward, given the current market situation and uncertainty. What we can see to date is very strong demand, actually, in places like Indonesia, Middle East, and Africa. Okay, because of the infrastructural development projects that are coming online as well as being planned for. And there are also industrial segments that are associated with electric vehicles are clearly on uptrend, and that would pull along the entire chain of supply in terms of from mining to the equipment required and so on and so forth, power generation. One of the points or questions that were raised by I think some of the people of the audience is nearshoring and friendshoring. I think these two issues will definitely result in reorientation of supply chains, and this will definitely impact vessel deployments. So as Rao pointed out early on, I think there will be a more complex rethinking of how to work with the oversupply of capacity. Now, increasing digitalization and adoption of AI in container shipping will definitely provide greater clarity and deeper insights into how container liners operate and drive for profitability. For special cargoes segment, how such information is leveraged will be the differentiating factor for the individual carriers. So with this, I leave you all to to share your thoughts for this evening. Thank you, everyone.
Thanks a lot, Patrick, for that very interesting presentation, and I'm sure informative indeed for all of us. So that concludes the sharing from our speakers, and I guess lucky for us all, leaves us with a couple of minutes and time to take some Q&A based on the questions that came in. And if you've got any fresh questions in the audience, do let us know so we can pose them to our experts. Maybe Tagjin, if I may start off with you. There was an interesting question that came in initially, and I think perhaps you'd have some good perspectives on it. So the question being, how best to plan for and manage the peaks and troughs in the shipping sector? Now, whoever posed that question put it in the context of resources planning. So if you want to take a stab at that as well. Tagjin, over to you.
Yep. Sound check. You can hear me, right?
Yes, you're good.
Okay, so just let me share a slide that illustrates the situation.
Oh,
so I think if we look at how the industry had invested in new ships over the last 25 years, we might kind of learn how not to do it. So this slide here shows the container ship fleet versus the order book as a percentage of total fleet over the last 25 years or so, beginning in 97 and then up to April last year. The boom and bust cyclical nature of the industry is fairly well established observation. And this pattern can be traced to the way that the industry invests in asset renewal. And by asset, I mean the largest that shipping lines invest in, and that is container ships. Let's look at the magenta line here, which is the ratio of capacity ordered against the total fleet. But more importantly, let's look at the timing of the orders. As you can see, there were dips in investments in new ships during the last 4 major crises in the 25 years between 97 and 2022. During the lean times, the shipping lines were reluctant to make investments in new ships. This is somewhat understandable, especially when a carrier is struggling to stay afloat and trying to remain cash flow positive. If you are old enough to recall, back in 98. That was when the Asian financial crisis happened. There was literally, like, not literally, but figuratively speaking, blood on the street. Reading on the books and things like that. A lot of fear. So there was not much confidence in the future, if there was a future at all. So if you look at that chart there, that also happens to be a point when the order books took a big plunge. Then maybe most of you would be aware of September 11, 2001. So again, more fear then. And similarly, you can see a dip in asset renewal. Container ship orders went down. Then fast forward about almost 10 years later, Lehman Brothers collapse, the so-called global financial crisis of 2008. You see another dip. Then just when we thought we've seen the worst of things in the world, COVID started in late 2019 and then went full-blown in around March 2020. And I still remember that at that time, shipping lines were really in a bit of a panic mode. I mean, obviously, if everybody was staying at home, then where's consumption going to head? And consumption is what drives the shipping industry. So what's going to happen? Okay, we just shut down, right? We stop spending money on stuff that we don't need. Let's keep money, cash, to survive. So this is exactly what happened over the last 4 cycles, major ones at least. As I was saying, during such lean times, shipping lines are extremely reluctant to make investments, and they just want to keep cash to try to stay alive. But unfortunately, obviously, it results in underinvestments. Ships will still get old and need to be replaced. Future growth needs to be accounted for. But of course, these considerations were ignored when shipping lines were just trying to survive. But what happens after a crisis is over? Well, generally the rates recover, carriers make some money, and then start to play catch up and rush to order new ships at somewhat high prices, resulting in the spikes that you see. So after the dips, you have the peaks. And then after you order those ships all together, what happens? Well, they all get delivered at the same time. And as was as discussed earlier on, over capacity results, competition increases, freight rates drop, and carriers start to lose money and the lean times return. And then even without external shocks, when the lean times are back, which, as I think we've all said in our respective presentations, that's kind of coming soon. What do carriers do in response? They hold back on investments again. Then the cycle repeats itself. And then we see the same kind of dips and peaks in investments. So the trouble is that this type of behavior potentially results in a carrier burdened with high fixed costs, becoming uncompetitive, and then therefore not earning enough to invest in itself, and ultimately becoming financially unsustainable. If you recall, just not too long ago, that was one of the reasons that Hanjin went bankrupt. They did not invest when they should have, and by the time they got in, the charter market was really high. They picked up ships at really high costs, and then at some point, they were just not unable to sustain it. So I think the simplest thing to do is learn from the past, as we can see here, and say, specifically in the case of Hanjin, there were others. How do I mean by that? Well, by investing in new capacity regularly, regardless of the market conditions. So you buy throughout the cycle, whether the prices are high or low. This way you average out the purchase price of the new ships. You won't end up being saddled with assets with high costs. then when there's a downturn, you are under less pressure than your competitor, whose slot costs may be higher because they bought at the height of the market. So in that case, going forward, when's the best time to invest regularly? Technically, that would be 25 years ago when prices are low. But that's water under the bridge. So when's the next best time then? Best time is now. And now is especially a good time for two reasons. Carriers, as we know, as Raul mentioned earlier on, have a lot of cash on hand. And the charter market, which I showed in the chart earlier on, has tailed off. So you've got cash, prices are fairly good. This is the time to go in. So I think that's the best way to sustain performance through the peaks and troughs of the shipping industry and not repeat the same mistakes that we've been making over the last 25 years. Thank you.
Thanks, Tagjin. I think that was very well articulated. Perhaps in continuation of that, if I may, since you've got that chain of thought, you gave us an interesting anecdote about how from 1894 was it, the shipping industry just doesn't seem to learn, and now we've got people rushing to build order books, and you shared a lot of those numbers with us. Do you think, given where balance sheets are and where the industry is today, we'll see more consolidation within the sector, and will that sort of change the dynamics and finally break this peak and trough game that seems to play out every few years within the industry?
So whether consolidation will happen or not depends on whether the industry as a whole has learned, and the industry today is in the best position to benefit from what has happened in the last 25 years. We don't even have to go back 130 years. And what do I mean? Today, most carriers are cash rich. We're talking about a lot of cash, billions of dollars of cash. So, so what do you do with when you have so much cash on hand? Well, obviously, one of the things to do is to return them to the shareholders, right? But a company must always remember to invest in itself, because if not, then they're gonna be in trouble in the future because they won't be competitive. So to grow, you can do one of two things. Do one of two things. One of which is, as you sort of mentioned, consolidation. So buying another shipping company. But then there's another thing that can do that is just to buy assets. So let me just address the first one. Whenever there's we have a situation like what we're seeing today, or at least will be coming up maybe in the next year or so, we always think that some companies will start to struggle, that may present a good opportunity. So therefore, the bigger ones will swallow up the smaller ones. But I'm not so sure if that is a wise move. And what do I mean? So when you buy a shipping company, you take over its assets and its book of business. The book of business will give you the revenue stream, which will hopefully materialize. The assets will add to your core business and give you economy of scale. But having discussed what carriers have done over the last 3 years, I wonder if these assets are really assets, or are they potential liabilities? What do I mean? Some of these assets, 25K ships, the 20K ships or 18K ships, whatever, were bought or contracted at really high prices. So such assets would increase the operating cost of the acquirer for the remaining life of the assets, which could be a long time in the case of ships. On charter, 5 years, and 5 years is long enough in the shipping industry. Or if you own it outright, for 20, 25 years. So for that period of time, you as an acquirer would have bought over assets, taken them into your books and depreciating them at very high costs. So in that instance, does it make sense for the cash-rich carriers to acquire the smaller ones when they could potentially be swallowing a smaller pill? Sorry, a poison pill. I'm not sure. What about the alternative? Well, the same cash could be used simply to buy assets such as ships and containers from the open market. If you remember the charts I have shown, especially for the charter hire market, rates have fallen off the cliff. So maybe now is the right time to use that money to invest in growth, but by way of buying assets directly rather than buying another shipping company whose assets might actually be rather expensive and for which future revenue streams can never be accurately predicted. So if the plan is to grow capacity and to invest in itself, then maybe buying assets directly from the market may be a better and cheaper option than acquiring a whole shipping line. And as was the case with Hanjin, nobody bought over its book of business, but it was simply absorbed by the other carriers. And one of the sort of known facts was how Maersk started a trans-Pacific trade, a brand new trans-Pacific trade, just to absorb the book of business from Hanjin. And the same thing can indeed happen again. So that's how I think might happen going forward. Thank you.
Thanks, Dakshin. So I guess the truth's out there, and I guess you don't get those crystal balls in Amazon. So we'll probably see how the industry plays out. Rahul, I have two quick ones for you that actually caught my eye. First one in continuation of the question that Dakshin, but more towards, you talked a lot about diversification and you talked a bit about digitalization and so on in the supply chain. So do you think we're, let's say, differently poised this time round post the COVID experience in terms of, how lines have diversified, how they're reaching out to customers, going into logistics also in the case of some? Does that finally break the chain or break the cycle? And does that sort of give us a different outlook for the next 5-10 years or foreseeable future?
Well, so that I think there's definitely going to be a sea of change overall, because today with digitalization, the only thing that's changing is getting more tech savvy. So right from customer service to operations, a lot of customers, or whether carriers look at it, they all want a level of service improvement. Today, if we look at it, shipping lines, I'm sure everybody would have seen the news. Hapag has made some big investments in South America, buying some terminals. Carriers have started getting back into the space of terminals. A few years ago, carriers were getting out of terminals, but today they want to get into an integrated model of solutions. So in my view, I think digitalization is here to stay. Niche products will be offered right from start towards end. People today, just how they want to be tech savvy, whether it's Instagram or whichever brand they use, they would also like to see their shipments digitally updated and what is the status of the same. Gone are the days of track and trace where, in previous years, you just saw where your container was when it moved from A to B. But today, during every part of the journey, you can see where your cargo is and even track it as to when it is being discharged and when it's available for delivery. Today, consumers, irrespective of them being in any part of the developed world or in parts of Asia or whichever way you look at it, they want to know when will they get their cargo, right till the end point in terms of even the cost. So I think carriers will slowly try and transpire towards a digital era where everything is available online and you can get things online. Of course, service providers who offer niche services will always be available to capitalize wherever they have the speciality. But digitalization is the future, in my view.
If you had time, I'd love to get a retort on that from Dakshin and Patrick, but I think we're running out of time here. Rahul, just quickly in maybe a minute or two, interesting question, so I'm posing it out. How receptive are customers to green energy pricing in your RFQ responses? Again, a question from the audience. I think it comes up quite often, so maybe a quick one from you before we wrap up.
So I think ESG is something which everybody is embracing at this point of time. As carriers embrace digitalization, I think ESG is the next big thing that customers are also looking at. customers want to reduce their carbon footprint. If there are methods, irrespective of it being ocean or well as air, where the fuel is cleaner, they want to really get into that aspect of it. So there are a set of customers who are willing to pay that amount of extra dollar for any ESG activity can reduce the carbon footprint. And it's there in all RFQs, it's there in all engagements with customers. And I think that's a good initiative for our planet as well as for our future.
Got it. Thank you, Rahul. Now, I noticed a few questions in the chat as well, but unfortunately, we're going to have to wrap up today's event, given we're pushing the hour now. So again, thank you, Tekjin. Thank you, Rahul. Thank you, Patrick, for coming on and sharing your views with us this evening. I think very interesting perspectives from all of you, and you've certainly given us much to think about, I'm sure, from the data points that Tekjin shared, from the evidence that Rahul presented in some of his slides, also linked to the logistics segment to a bit, and then Patrick with the special cargo segment that you shared with us, and perhaps a solution to some of the problems that the liner industry is facing right now in terms of more focus on special cargoes and projects. But with that, I would like to call the proceedings of this evening to a close. But before I do that, I'd like to remind our audience to please also register and dial in for our next webinar titled Distribution Logistics and Last Mile Challenges. This is in continuation of our series on urban logistics to be held on 24th August at 11 a.m. Details as presented on the slide on your screen. So again, with that note, thank you to all of you that dialed in today. I hope you found the discussion useful, and we certainly hope to see you again soon. Very good evening, and I guess good day to all of you. Thank you.